Hello, everybody. Thanks for joining today's webinar. We have a very large group joining us today, and it is just now 10 o'clock. So we're going to hang out just for about 60 seconds while people figure out how to log in. So kick back and hang tight. We'll start in about 60 seconds. All righty, looks like we're still getting people logging in, but I don't want to delay too long, so let's go ahead and get started. So thank you everybody for joining today's 1031 Exchange webinar. As many of you may know, we run a series of 1031 Exchange webinars throughout the month. We have already done our basics webinar, and this week we are going to talk 1031 Exchange advanced strategies. My name is Leonard Spoto, and I am one of the owners of a 1031 exchange company called Asset Exchange Company. And what our goal is today is to talk a little bit about 1031 exchange and a little bit of housekeeping before we get started. We do have a lot of people on the call today, but if you have questions during the course of today's presentation, we do encourage you to get your questions on over to us. The way that you can ask a question on our webinar is to type your question into the questions dialog box. The question will pop up on my computer screen, and I will try to address all questions as appropriate. Now, what that means is some of you will ask a question early in the presentation about a topic that I'm going to cover later in the presentation. So don't think that I'm ignoring your question. It's just that we'll probably postpone that discussion for when it's going to come up naturally in the conversation. And then sometimes we get inundated with questions and we just can't answer all of the questions that come over to us. And in that case, what we will do is we will email you after the presentation with answers to your questions. So please do, though, if you have questions, do go ahead and test out that questions dialog box. I see some of you are already doing it, and I appreciate that. So it is working. All right, housekeeping item number 2, presentation material. Everything that you're seeing on today's presentation will be emailed over to you. We send out the email about an hour after the presentation ends. So keep an eye out for your email if you would like to receive a copy of today's material. Some of your emails will block me and put me in spam, though, so if you don't see the email in about an hour, just go ahead and check your spam folder. And then very importantly, a little bit of sales on my side. The reason why we do these presentations is because we want to earn your business and we want to earn your referrals. We are a 1031 exchange accommodator, and part of the marketing that we do is big educational outreach webinars like we do here today. And we do them because we want to make a good impression on you. And if you think we do a good job today, that is the exact same impression we're going to give your clients when we work with them to handle their 1031 exchange. So if you think we do a good job today, please keep that in mind when you have an upcoming 1031 exchange, because we certainly do these educational training seminars, not for fun, but so that we can work with you in the future. Okay, so let's go ahead and get started. So as I mentioned earlier, my company is a 1031 exchange accommodator. And I go over a little bit more detail what that means in our basics class, but just so that you remember here, anytime you do a 1031 exchange, you need a 1031 exchange company or an accommodator to facilitate the process. And exchange companies all do the same thing. Number one, we're going to hold the funds from the sale of the property, and we're going to hold on to those funds until the client is ready to purchase replacement property to complete their exchange. Number two, we're going to prepare all the legal documents that are required to properly document the transaction as a 1031. And then number three, and very important, we're going to make sure that our clients are in compliance with all the rules and regulations set forth within the tax code. Now, my company has been doing this for a very long time. We started this company back in 2006, although I've been in the business since 2002. The company, Asset Exchange Company, is legally required by state law to be bonded and insured. We have a tax attorney on staff who is licensed with both the California Board of Accountancy and the State Bar. We have exchange officers who speak Mandarin, Cantonese, and Spanish. And then one of the things that is really good about our company is we are the only company in the industry to offer our clients free audit support. Now, if you get audited on your transaction and you work with us, our tax attorney will help provide substantiating evidence that you followed all the rules and regulations to properly defer taxes. So you don't have to go out and hire a $1,000 an hour tax attorney to help defend you against an audit. What you do is you give us a call, and our tax attorney will do that work for free as part of our service. So hopefully you never need to use that, but if it is required, it is one of the most invaluable things that we can offer. About 5% of our clients, unfortunately, do get audited every year. So if you do get audited, it's good to have someone who knows the tax law better than the auditors. So that's a little bit of information about us. Now, let's talk 1031. So Section 1031 of the Internal Revenue Code has been called the single greatest wealth building tool available to investors. Now, why is that? Well, it is because with Section 1031, you can sell an investment property and defer the tax payment that would have otherwise gone to the government. And that's a big deal because here in high states like I am in California, about 33% of your profit or your gain goes to pay taxes if you cash out and just sell your real estate. So if you can keep that money in your pocket instead of sending it to Uncle Sam, that is going to provide you with a lot more purchasing power for your next transaction. I routinely work with clients who save $200,000, $300,000, $400,000 in taxes. Some of my very large clients save $1 million in tax liability by doing their 1031 exchange. So this is a very, very powerful tool. If you are a real estate professional, if you are a real estate investor, Section 1031 is something you should become proficient in. It is going to help you build wealth and preserve your equity. Now, I gave you that number, 33%, right? And the way I get that number is by combining the state and federal taxes. So let's go ahead, because this is our advanced 1031 exchange class, and talk a little bit more in detail about federal and state taxes. So a lot of people call my office and they say, well, geez, Leonard, I think I might just go ahead and just pay my taxes because it's only 15%, right? Wrong. It's not, okay? 15% is the starting rate for your federal capital gains tax. Most people, if they're in an income bracket that's a little bit higher, are actually going to pay 20% at the federal capital gains tax. But that's not the only federal tax that you pay. There is also a tax on the amount of depreciation that you have taken. So it's called the depreciation recapture tax, and that is a rate of 25%. And then we have what we call the Medicare tax, which kicks in at certain income levels. Most of you will be in that, and that rate is about 3.8% as well. So you've got different types of federal taxes that you're going to have to pay if you decide to pay taxes and just cash out of your real estate. So that's our federal tax, but we don't stop there. Depending on what state you're in, you're going to have state taxes as well. And I think most of you, like me, are in California. If you're not, your taxes may be different. But here in California, our taxes are going to start at 9.3% and then go up depending on our income. So you can see our brackets here. Now, of course, these are always subject to change, and they may change with different administrations, but that's what we're at right now. So if you combine all of those, you get a rough kind of blended average of about 33%, as I mentioned. Now, 33% is a big number, but a lot of people don't understand how to apply that number. So let's, again, because this is our advanced class, dig in a little bit deeper to the details. So when we look at our taxes are based on our gain. So it's very important that as a real estate professional, you understand how gain is calculated. The way that we calculate our gain is we take our net sale price and we subtract our adjusted basis. That simple math equation that most of your 10-year-olds can do gives us our gain. Now, the big question there is, though, well, what the heck is my adjusted basis? Well, your adjusted basis is going to be the purchase price that you paid for the property minus your depreciation, and then you're going to add back your capital improvements to get to your adjusted basis calculation. So let's go ahead and do an example here. The first thing we're going to do is just look at our set of facts for a property that we own. All right, my facts here on the board state that I bought a property, let's say 20 years ago or 10 years ago, it doesn't really matter, and I paid $500,000 for that property. Over the duration of my ownership on that property, I have taken a total of $100,000 of depreciation. At one point, I had to put a new roof on the property, and that cost me $25,000. And I am now in contract to sell the property for a net sale price of $1 million. Okay? And please note that I said net sale price. And so what that means is after commissions and closing costs. Right? My net sale price is $1 million. Now, based on that information, I can very easily give you a quick estimate on what your tax bill is going to be. First thing I'm going to do is I am going to calculate your basis. So the basis is, as I mentioned, what you paid for the property minus your depreciation plus your improvements to give you a number of, in this example, $425,000. So ladies and gentlemen, what that means is if you sell your building for anything above $425,000, you're going to have gain, right? And if you have gain, you have taxes. So in this example, my gain is a pretty easy number to calculate. I'm going to take my net sale price of $1 million. I'm going to subtract out my basis, and I am going to have a gain of $575,000. Now, I know that most of you on this call are not CPAs, but after you take this class, you're going to be more than qualified to tell your clients approximately what their tax bill will be if they cash out of their real estate and decide not to do an exchange. It's going to be about 33% of that number, okay? So about 1/3 of this number will go to pay taxes. Now, if you want, and you are a CPA, you can actually do the math for your client. If you're not a CPA, I don't recommend it though. But let's kind of dig a little deeper into the numbers. So as I mentioned, there are several federal taxes. We have a depreciation recapture tax, which is 25% against the total amount of depreciation. So we said we took $100,000 of depreciation. We have our federal capital gains tax, 20% because we're at the higher level. We have our federal 3.8% Medicare tax, and then we have our state taxes kind of broken down between our 9.3 for the first 500, and then anything over that gets taxed at 10.3%. So we've got a tax liability of almost $200,000 on this simple transaction. Now, for property owners in California, this is kind of a standard situation, right? This is a building that I see transacted all the time. People bought for maybe 10 years ago, 15 years ago. It's appreciated quite a bit. And if they sell the property, they've got about $200,000 in tax liability to pay. Most of my clients, to be fair, have bigger tax liabilities than this, because most of my clients have seen more appreciation than that. Now, that's the bad news, is you've got a big tax bill to pay. The good news is that because you are selling real estate, there are very favorable tax laws to help you avoid paying that tax. Now, there are two tax laws that everybody on this call should be very familiar with. The first one is what we're going to talk about for the total time today, which is Section 1031 of the Internal Revenue Code, which everybody should know if you're paying attention so far. This tax law allows you to defer taxes on the sale of your investment property. But there is another piece of tax law that a lot of people know about. It is the homeowner's exemption, Section 121 of the Internal Revenue Code. This piece of tax law allows you to sell a primary residence and completely avoid paying taxes. Now, the tax avoidance is somewhat limited, okay? If you're single, you can only avoid taxes on the first $250,000 of gain. And if you're married, you can avoid taxes on the first $500,000 of gain. Now, these are the two tax laws that are available when you sell real estate. Okay, you either have your 1031 exchange for your investment property, or you have your homeowner's exemption for your primary residence. Please note, there is no tax law on this screen for your second home. All right, very, very important. A lot of people think, well, geez, I've got a second home in Palm Springs. Which tax law can I take? Well, if it's a second home, it's not an investment property, so you can't take your 1031 exchange. Your second home is not your primary, so you can't take your homeowner's exemption. So there are no tax breaks when you sell a second home. You've only got tax breaks for investment property, and you've only got tax breaks for the home that is considered your primary. Now, one of the great things about the tax law, though, is that these two tax laws are not mutually exclusive. And we're going to go over this in a little bit more detail later in the presentation. But there are opportunities where you can use these two tax laws together for maximum benefit. Okay? You might have a property that is part investment and part primary. Well, if so, then you can take the 1031 exchange and the homeowner's exemption. Right? So we can do blended transactions where we take some homeowner's exemption and some 1031 exchange. And I'll go into a bit more detail about how to do that in a slide further in the presentation. Okay. What I want to do right now, though, is just let you guys know that these are the only two tax laws that come into play when you sell real estate. All right. You're going to sell investment property or primary residence property, and you're either going to get the 1031 exchange or the homeowner's exemption. All right. Okay. So let's dive into a little bit further the 1031 exchange process. Now, again, this is our advanced class, so I'm assuming that you have some base level knowledge of the 1031 exchange process. So I'm not going to spend too much time on these guidelines. I'll go over them briefly, but I want to save some time for, we do have a special guest speaker. I want to save some time for our guest speaker, but I also want to save some time to dig into some of these more advanced kind of complex ways to do 1031 exchanges and to benefit and combine things, okay? So, and I know a lot of you guys have posted questions already, and I appreciate that. I'm definitely not ignoring you. It's just that a lot of questions are really filtering in now, and I'm going to have to save most of them for the end of the presentation. Okay, so let's talk 1031, right? If you're going to do a 1031 exchange, you got to make sure that you're following the rules. And let's go over the rules real quick. Number one, okay, first rule for any 1031 exchange, you got to make sure your property is qualified. Okay, tax code says that only properties used in productive use in trade or business or for investment will qualify. Tax code also stipulates that properties involved in an exchange must be like kind. Now, foreign property is not like kind. You cannot exchange a property in the United States for something outside of the United States. Inventory is not exchangeable. Inventory is your quick flips. Inventory is development projects, okay? But outside of those two kind of restrictions, you do have a lot of flexibility. So you can sell land in Fresno and you can buy a rental home in Texas to complete your exchange. You could sell that rental home in Texas and you can buy an apartment building in Missouri. You could sell the apartment building in Missouri and you can buy an office building in San Jose. You've got San Jose, California, okay? You've got a lot of flexibility. You can go into different types of real estate. You can go into different parts of the country, but you do have to stay within the United States, okay? So rule number one, properties must qualify. Rule number two, if you do not want to pay taxes, you have to remember a couple things. Number one, you have to reinvest all of your cash. And number two, you have to purchase property equal or greater in value. Now, we're going to talk about net sale price, okay? So I'm going to get in contract to sell for $1.1 million. I'm going to pay $100,000 of commission and closing costs. That means I have a net sale price on this property here of $1 million. Ladies and gentlemen, if I don't want to pay taxes, how much real estate do I have to buy to complete my exchange? That's right. I have to buy $1 million worth of real estate. All of the cash that is generated from the sale of this property after paying off any loans is going to be used as the down payment to buy my real estate. So my cash from the sale of the property first comes to the exchange company. You guys are going to go out and look for property. When you find something to buy, you're going to use that cash that's sitting in the exchange account as a down payment to buy your property. Now, you might not have enough cash in the exchange account to buy $1 million worth of property. So you can do one of two things. Number one, you can go out and get another loan, right, to come up with a difference. Or number two, you can contribute additional cash out of your pocket, all right? So a lot of people think in a 1031 exchange that they have to replace their debt. Now, most people will, but you don't have to because you can always contribute additional cash out of your own pocket if you don't want to go out and get a loan, all right? So a couple misconceptions there, right? People think you have to replace your debt. No, you don't. You can always contribute additional cash. What you want to do is you just want to make sure that you're buying enough real estate so that you can satisfy your exchange requirement. All right? I sold for a net sale price of $1 million, so I need to make sure if I don't want to pay taxes, I buy for $1 million or more. If you do that, you defer all of your taxes. Now, you can do that creatively, right? You could sell one property for $1 million, and you could buy two properties, one for $500 and another one for $500. That gets you to your $1 million mark. You could buy three properties. You could buy five properties, all right? So you can do multi-property exchanges if you want. You can actually sell multiple properties and combine the sale proceeds into one large property. That works as well. You can sell one by two, sell one by four. You've got some flexibility in how you structure your exchange. And then finally, you can also do what I call partial exchanges, where you sell for $1 million and you buy for something less than $1 million. So in my example here, I'm going to sell for $1 million and my replacement property to complete my exchange is only $900,000. Now, that does not disqualify the entire exchange. What that does is it simply leaves you with a tax liability to be paid on the $100,000 difference. So whenever you trade down in value, you pay taxes on the difference up to your gain amount. All right? So rule number 1 is make sure your properties qualify. Rule number 2 is if you don't want to pay taxes, you need to reinvest all of your cash and purchase property equal or greater in value. Rule number 3. Now, most of you are familiar with this rule from Real Estate 101. Whenever you do an exchange, you need to get your exchange completed within the 180 days. All right, so your time frame for your 1031 exchange is going to start the day you close escrow. You have 180 days, or about 6 months, to complete the entire process. And what that means is you have to purchase and close escrow on the replacement property or properties on or before day 180. All right, so 180 days total time frame to do your exchange. Should be plenty of time to complete the process. The 180-day time frame is not what usually stresses my clients out. What is really challenging and stressful for most of my clients is what they have to do on day 45. Now, in an exchange, you're going to sell something and you're going to buy something. On day 45, the government says that you actually have to identify all of the potential properties that you are thinking about buying. So day 45, very important. That is the day your identification letter is going to be due. Now, when you submit that letter, the government gives you rules, of course, for how to fill out the letter. So take a look at your screen. This is the identification that you will identification letter that you will use if you work with my company. Your exchange officer will provide you with this letter and remind you to fill it out on time. When you fill out this letter, there are essentially 2 options for how to complete the letter. Option number 1, you can use the 3 property rule to fill out the letter. The 3 property rule allows you to submit 1, 2, or 3 properties. Now, very importantly, once you submit your ID letter on day 45, you cannot change that letter after day 45. So if property number 1 gets sold to someone else, you've got to go to property number 2. If property number 2 gets sold to someone else, you've got 1 property left on your letter that you can purchase. If you, for some reason, cannot acquire this property, guess what, ladies and gentlemen? You're out of luck. All right? Property number 3 gets sold to someone else. You cannot go out and submit any other properties after day 45. We cannot release funds for any other property because it wasn't specified. So you, at that point, become a taxpayer. So very, very good idea to go out and identify property that you think you've got a really good chance of getting into contract on. And a lot of my clients will identify DSTs as a backup for just in case they can't get their first or second choice. Now, we do have a guest speaker who's going to talk a little bit about DSTs today. I don't want to steal his thunder, but these are very good options for people who like passive real estate, and they can be very good options for people who, as I mentioned, want a backup where they have certainty of closing. So we will talk about that as well in a little bit further in the presentation. So your first option for filling out your ID letter is to use the 3 property rule, but that only works if you want to buy 1, 2, or 3 properties. What happens if you sell in California for, let's say, $10 million and you want to go out and buy 15 properties in Texas? Well, you can do that, but you have to identify using what is called the 200% rule. Okay? With the 200% rule, there is no limit on the number of properties you can identify. All right? So I can identify, in my example here, 6, 7, 15 properties. There's no limit on the number of properties. However, we do have a limit on the value of all this real estate. Okay? Using the 200% rule, we cannot identify more than 200% of the value of what we sold. Now, because we sold a $10 million property, that's going to get us a lot of real estate to identify. That's going to get us $20 million worth of property to identify. So for those people who are selling very expensive properties, the 200% rule may work very well. For people who are selling in California and buying in Texas, where Texas property is really, really cheap, and you can still get something for $100,000, the 200% rule might work well. So those are your options. Those are the guidelines. Again, we go over these fairly quickly because we assume most of you are familiar with the process or have taken our 1031 exchange basics classes. But to summarize, you've got 4 essential rules for doing an exchange. Number 1, you got to make sure your property's qualified. You have to reinvest all of your cash and purchase property equal or greater in value. You got to get your exchange done on time, and you have to identify what you're thinking about buying on day 45. Now, when you do a 1031 exchange, if you can't remember the rules, if your client is arguing and they said, no, my brother's uncle's best friend did an exchange and he didn't have to identify on day 45. The thing that I want you to do is pick up the phone and give me a call, all right? So if you don't have my toll-free number saved in your cell phone, please do put that number in there, because at some point, whether it's today or next year or in 5 years, you're going to have a 1031 exchange issue. You're going to forget some of these basic criteria that we talked about today. And if you've got me saved in your phone, I'm one phone call away to explain all of this stuff to you. So go ahead and take a little bit of time now, put my phone number, my toll-free number in there. That's going to be able to get either myself on the line or any of my staff who can explain these rules to you. We went a little fast today, so if you do need further information about that, shoot me an email, or again, you can call us. Now, I went fast because I wanted to talk about the fun stuff, okay? There is some fun stuff in the 1031 exchange world, and I know that someone asked on the chat here if we could talk about reverse exchange, so let's go ahead and do that, all right? Reverse 1031 exchange, what's that? Well, in most exchanges, what we do is we sell a property, and then we take up to 180 days to go buy something. Well, in a reverse exchange, we do the opposite. We buy a property, and then we have 180 days to sell. And provided we sell this property within 180 days, that sale will be tax deferred. Now, I know many of you are thinking, geez, that sounds fantastic. Let's do that, right? Okay, there's a lot of reasons where you might want to do a reverse exchange, okay? You're walking down the street and you see a beautiful property that's for sale and you want to close on it right away, okay? There's a perfect opportunity to seize the moment. You want an insurance policy, right? You want to make sure that you know you can sell your property, but you want to make sure you can buy something. So why don't you buy it now? And then some of my clients, they just have poor planning, right? They put their property up for sale. They thought it was going to sell real quickly. So they made an offer, and then their property is not selling as fast as they thought. So they're forced into doing a reverse exchange, okay? A lot of different reasons why you might want to buy first. Now, let me tell you about why you might not want to do it, okay? The reverse exchange is not going to make sense for most people, okay? I generally advise my clients to avoid reverse exchanges if possible. And the reason is you cannot go out and own the new property and the old property at the same time. So if you want to just go buy a building and then sell something later and call it a reverse, that's not going to work. In order to buy this building first in a reverse exchange, the very first thing you have to do is call me, okay? So my phone number is down here. Again, you're going to have to call me because I am going to have to become a straw buyer for this property. You cannot own the new property and the old property at the same time. I am going to become a straw buyer for the property that you want to buy. Okay, technically it's called an exchange accommodating title holder. You don't care about that though. Okay, it's a straw buyer. I become the owner on title to this property. I give you a lease so that you can have all of the burdens and benefits of that property. It's essentially yours, but for legal purposes, I'm on title. And I am going to be on title to this property until you get your property sold. Once you can sell this property and close escrow, only at that point will I transfer the new property to you. So we're playing a shell game, right? I temporarily take title to the property that you want to buy. Once you get your property sold, then we transfer the replacement new property to you. Now, why is that difficult? Well, it's difficult because if you're going to go out and get a loan, the lender who loans you money to buy this property wants you to take title to it, not my company. So financing is going to be very difficult. Now, some of you might say, hey, I don't need a loan. I'll pay all cash. Okay, all cash will work. And it makes the process a lot easier. But when we do a reverse exchange, the moment I go and take title to this property, there are escrow fees and there are transfer taxes and there's title, right? So we're going to pay all those. And when I say we, I mean you, the client. And then that is just for when I'm on title. Now, you haven't taken title yet, but when you do, you will pay all those fees and transfer taxes again. So to get a reverse exchange done, it's going to take a little bit more in fees and costs. My fee is actually a lot more to do a reverse exchange too, because I'm on title, I've got liability, there's a lot more work for reverse exchanges. So by and large, you can guarantee that a reverse exchange is going to cost you a lot more money. Now, how much more money? It depends, right? In certain counties, transfer taxes are really, really high. Some places, they aren't. So transfer tax is generally the biggest additional fee that you will pay when doing a reverse exchange. And if you find a lender who will loan on it, it's usually going to cost you a lot more in terms of points. So there are some lenders, and they're generally hard money lenders, that will loan on these reverse exchanges, but their fees are kind of outrageous. So yes, a reverse exchange is possible. It is a lot easier if you're paying all cash, but it will still be more expensive than a traditional exchange. All right. So I have probably 50 people who call me a week wanting to do a reverse exchange, and maybe one of them will end up doing it. Now, another type of exchange that you can do as an exchanger, and this is kind of an interesting one, again, in theory. It's a construction exchange where you use your 1031 exchange dollars to build or improve a property. So what you're going to do is you're going to start off with a regular exchange. You're going to sell your property, okay? This property here, you're going to sell, and when you sell that property, the funds will come to the 1031 exchange company. Now, you go out and you find a piece of land that you want to build on, which is fine, okay? But you cannot own this land until the building has been completed. So what I'm going to do, just like in a reverse exchange, I am going to become the straw buyer for this land, okay? I'm going to be on title for you so that you can then build on the land using all of your exchange money. And then once the land has been built and the project completed, we can transfer a new completed, improved property to you to complete your exchange. Oh, and guess what? You got to get all this done within the 180-day exchange time frame. So you have 180 days to go, first of all, locate and buy the land where I take title to get your contractor to start digging and framing and doing all that work and complete the project within the 180-day time frame. So, ladies and gentlemen, how many of you out there think that you could do that within 180 days? Not a lot of people can, because it's tough. You've got permitting, right? You got to get your contractor lined up. And 6 months to get that done. Geez, I couldn't even do my backyard project in 6 months, and I was doing just a remodel of my backyard. It took me 12 months. So it is possible to use a construction exchange to build from the ground up, but it can be tough. What most people will do with a construction exchange is they will buy an existing property that needs some work, and then they'll spend their leftover exchange dollars to fix up that property. Okay, that is a much more practical use of the construction exchange. But it is possible, okay? And we're talking complex things in our advanced class today, and this is a complex way to do a 1031 exchange. Okay, let's go ahead and move on. And again, I see your questions, ladies and gentlemen, but I do want to go quickly because I've got a guest speaker and we've got a ton of stuff to talk about. I'm going to try to get through as many of these advanced issues as possible, but it might not be feasible to get through all of them today. But I do want to talk about one of the things that I think is the greatest thing in the 1031 exchange kind of world, and that is taking a very appreciated primary residence and converting it into a 1031 exchange property. Okay. Now, why would I do that? Well, if you bought a home 20 years ago for $100,000 and it is now worth $1 million, you have $900,000 of gain. If it is your primary residence and you're married, the most that you can avoid paying taxes on is $500,000. Unfortunately, because your home has appreciated above that, you have $400,000 of gain to pay taxes on, and that's going to be about $100,000 to $120,000 in taxes. So you have a decision to make. You can go ahead and sell that home, that primary residence, and pay the six-figure tax bill, or because you took this class, you can talk your spouse into moving out of the property and renting it out for 2 years. You can season that property as an investment for 2 years so that when you sell it, it will be eligible for what? The 1031. Okay? If you sell this property after 2 years, you have the potential to do an exchange, but because you've also lived in the property for 2 of the past 5 years, you also have the ability to take your homeowner's exemption, Section 121 of the Internal Revenue Code. Now, ladies and gentlemen, let me ask you a question. If you have a property that is eligible for the 1031 exchange and the homeowner's exemption, which one do you take? Well, I'm going to answer that for you. You take both. That is right, ladies and gentlemen. If you have converted your primary residence to a rental and you are eligible to do an exchange and also eligible for the homeowner's exemption, you can take them both. The way that that works is that you will sell the property for $1 million. The first $500,000 of gain will come out of the property. Okay, so you've got your $1 million property. The first $500,000 of gain comes out tax-free. That leaves you with a value of $500,000 that you can conduct a 1031 exchange on and defer all of the remaining tax liability. That, ladies and gentlemen, is probably one of the best kept secrets in real estate. I had a client in Palo Alto who bought a property for $76 $100,000. It was a primary residence for over 30 years, and it was worth $5 million. Okay. The client used this strategy and saved over $2 million in taxes. Okay. This is a gold mine for your clients who have lived in their properties for a long time, because it gets them to sell the property at zero tax consequence. Now, the problem with this strategy is twofold. Number one, you have to move out and you have to rent the property, so the client needs to go out and find somewhere else to live. And then problem number two is that once they sell the property, to really maximize the tax benefit, they got to do an exchange. And they have to go out and exchange into another investment property. Now, some people won't want to do that because they won't want to manage real estate. Now, that's why I have a guest speaker on the call today, is because there are investment properties called DSTs that you can own that are completely passive. So for a 75-year-old person who is employing this strategy, they might not want to go out and buy a 2-unit building or a 4-unit building or a rental property. But if they can exchange into a passive investment that cash flows 4 to 6%, that they don't have to manage, that might be a perfect strategy for this client. So very, very powerful stuff. And our goal today is to teach you these concepts and introduce you to the right people who can help you pull them off. All right. So concept number one. Now, I'm going to jump again, guys, I'm going to jump around to a couple other things here because I'm running out of a little bit of time. What I do want to share with you as well is we talked about using the homeowner's exemption and the 1031 exchange together. You could actually have a 2-unit building. So this is a 2-unit building in San Francisco. The client rents out the top and they live in the bottom. Okay, this is another situation where you can do a 1031 exchange on the value of the rental and take your homeowner's exemption on the portion that you live in. Now, your CPA is going to figure out the percentages, right? And it's usually done based on square footage. But if you are living in a property and you're also renting it out, when you sell that property, you can do your homeowner's exemption and the 1031 exchange. And for the real estate agents on the call today, guess what? It doesn't have to necessarily be a rental. You can have an office, right? So maybe 20% of your property is your home office. Well, guess what? You sell that home, you've got 80% allocated to the primary residence, and you've got 20% to your home office. You can do a 1031 exchange on that 20%. All right? Very, very, very important stuff. Now, another thing you could do, you could sell $1 million property. It's 100% investment. And you can buy a mixed use property where you live in a portion of it. So you buy a 2-unit building to complete your exchange, and you live in one of the units and you rent out the other unit. So I just did a 1031 exchange to a 2-unit building, and I'm going to live in one of the units. Is that allowed? Absolutely, as long as the rental unit satisfies your exchange requirements. So we sold our investment property for $1 million. I need to make sure that the rental component of this property is worth $1 million. And if so, I'm going to have a fully tax-deferred 1031 exchange. So again, you can be creative in how you complete your 1031 exchanges. You can do the same thing with a bigger building, right? You can sell your rental property for $1 million. You could buy a $4 million property, and as long as you rent out 25% of that $4 million property, you can live in the other 75%. So what you just need to do is make sure that you're satisfying your exchange requirement, right? You sold investment property for $1 million. Are you buying $1 million worth of investment property? Well, yeah, absolutely, as long as you rent out 25% of it. Okay, I'm going to jump through just two more things, and then I'm going to pass it over to our guest speaker. I think one of the most important things that I can talk about is on this slide here. So if you fell asleep, wake up and pay attention. Okay, this is what I call the swap till you drop method of investing, or some people call it the 3 Ds of investing. Okay, pay attention. You're going to do an exchange and you're going to sell some land. So you're going to sell your land, you're going to exchange into a rental home. Did you pay taxes? No. You're going to do another exchange into another rental home and then another into an apartment building. Did you pay taxes? No. Sell that apartment building, buy another one. Sell that apartment building, buy an office building. Have you paid taxes on any of these 6 transactions? No. You've done a series of exchanges over maybe 20 or 30 years. You have never paid taxes on any of your transactions. You cash out of this building. You're done with real estate. You pay the piper. You're done. You say, I'm done. I don't want any more real estate. Cash out everything. Guess what? You're going to pay taxes. You're going to pay taxes on the gains associated with this property and all of the previous transactions. So if you have done a series of exchanges, you are accumulating gain on each one, and you will pay taxes on that gain when you finally stop exchanging. So what do? Well, you pay taxes, or you simply never stop exchanging. Okay, you do what we call the 3 Ds of investing, or the swap till you drop method. You will simply defer paying taxes, you'll defer paying taxes, and then you will die. You will own real estate until you pass away. And ladies and gentlemen, when you pass away, this big shiny building that's worth $10 million will get passed to your heirs, probably your children, at what's called a step up in basis. And the capital gains tax liability that you have been deferring throughout your investment lifetime goes away. Your kids can literally sell the property the day after your funeral and pay 0 capital gains tax liability. Now, again, you might be in a situation, or your clients might be in a situation where they're thinking, well, geez, I'm 80 years old. I don't want to manage this big building. Well, that's okay. Again, you do not have to manage traditional real estate. In a 1031 exchange, you have the option to buy passive investments, okay? Those passive investments, again, are called DSTs, and I am going to pass the presentation over to Jason McMurtry, who's going to explain what a DST is, because it can be a very powerful tool for you and your clients in their ultimate end game in 1031 exchanges. Okay, before I pass it over to Jason, just make sure you get my information. Again, my phone number has been on all the slides. All my contact information is here. But Jason, are you there, buddy?
I am here. If you could give me control, I will share my screen here. And while he's doing that, I want to thank everybody for being on here. And really what I want to do is just give a high-level overview of what DSTs are and how they can solve some of the problems that Leonard mentioned during his part of the presentation. And I don't know what just happened here.
You have control now, Jason. We can see your screen.
The presentation or my second screen?
I can see you need to enlarge your presentation, but we can see what you have.
Okay, that's not what I meant to do. Sorry about this. There, now you should see the presentation. Okay, so
Perfect.
as Leonard mentioned, 1031 exchange can be a really powerful tool. It does have some limitations, and DSTs can be a really powerful way to deal with some of those limitations. So in about 4 minutes, maybe 5 max, I'm going to go over what DSTs are and how they can solve some of these problems. And then I'm going to give my contact information so that anybody that wants to have a follow-up conversation or an email can have that with me. So a little bit about 1031 Capital Solutions. We specialize in helping 1031 exchange investors exit real estate that they manage and go into something that's 100% passive. We've done over $300 million in transactions in our, we're going on our 8th year in business here. And we have a best interest or fiduciary duty to our clients to make recommendations regarding their 1031 exchange and their investments that are in the client's best interest. So let's jump right in. What is a DST? A DST, think of it like a fund that typically owns a single property. So an example might be a 400-unit brand new apartment building in Denver, Colorado. And instead of somebody selling $1 million property and replacing it with $1 million property, they might sell $1 million property and replace it by owning 1% of this $100 million apartment building in Colorado, as an example. The IRS looked at this structure 21 years ago and issued Revenue Ruling 2004-86 that said DSTs are absolutely 1031 exchangeable in and out. And the number one reason that people invest in these structures is because they're 100% passive. So if you invest in a DST property, you never deal with the tenants, you don't deal with the property managers or asset managers. You simply get your pro rata share of the monthly net income. You get all of the reporting done, the tax reporting at the end of the year. You have 100% participation in the capital appreciation of the property, and you maintain all of your tax benefits like operating costs and depreciation write-offs and the like. So it's very much like owning any other property. The main difference is you own a fractional interest of it, and all of the operations are handled by a large institutional real estate investment company. Some of the problems that DSTs can solve in terms of a 1031 exchange, Leonard mentioned the ID rules. A lot of people put 3 properties on their ID letter. And if all 3 of those properties get sold or pulled off the market, then you're sort of out of luck. So people will sometimes put a DST as that third option. So if property number 1 and property number 2 aren't available, rather than having to pay tax, they can slide into the DST and then ultimately come out of the DST down the road and go into something that they really like. DSTs are also really valuable when you're trading down. So I sell $1 million property and my replacement property that I really love that meets all my needs is only $900,000. Well, rather than paying tax on that $100,000 difference, I can invest that $100,000 into a DST. I've deferred the taxes and generated income off that $100,000. So it allows much more flexibility when looking at replacement property. The other way that DSTs can be extremely helpful in a 1031 exchange is with financing. Leonard mentioned earlier in the example that he gave, there was a $500,000 loan. Well, what if somebody sells a property and they go to get a loan to buy the replacement property and they just don't qualify for some reason, or the interest rates are too high to make it work? If you go into a DST, you do not have to go out and get a loan. You don't have to apply for the loan or make any debt payments. All of that is handled through the DST structure. And so there's some sticky situations that can occasionally arise throughout a 1031 exchange transaction, and DSTs can solve a lot of those problems. But I think the most exciting message I want to share with those of you that are agents on the call today is this. There are a large number of people in the United States in their 60s and 70s and 80s that own rental property, that if they knew that there was a way to exit that property without paying tax, they would sell the property today. They just don't know there's a way. And if you're a real estate agent and you introduce the concept of a DST to them, and you say, Mr. or Mrs. Jones, did you know that you could sell your property, not pay any taxes through a 1031 exchange, and then own something that's totally passive, where you have the potential for monthly cash flow and appreciation and tax benefits, but you never have to deal with tenants and roofs and asset managers and refinancing loans and all of those things. Those are all behind you. Some of those people are going to get really excited and want you to sell their investment property for them. So that's really where there's an opportunity for you. If you have somebody in that situation, we're happy to run a cash flow and tax analysis with you for them so that they can get a sense of what their property looks like and how it compares to alternatives. We have a library of free resources on our website, 1031capitalsolutions.com. You can find DST investor checklists, brochures, webinar recordings, short and long videos, all sorts of free information. If you want a copy of my book, How to Retire from Being a Landlord, it talks about everything I've just talked about here and a heck of a lot more. I'll send you a free paperback copy. Just email us. You can email me directly, jason@1031capitalsolutions.com. Just let me know you want a free copy of the book and tell me where to send it. If you have questions about DSTs or how you can incorporate them into your business to help your clients in a 1031 exchange, just give us a call at 800-445-5908 or email me at jason@1031capitalsolutions, or of course, just go to the website at 1031 Capital Solutions. All right, Leonard, I went 1 minute over, but I think I kept it pretty tight here. Back to you.
And I've known Jason for a long time. He has helped a lot of my clients who've been in a pinch and just people who just don't want to manage real estate. And Jason does hour-long webinars just on the DST process. So please do check Jason out. If anything, it's just good to know the options of what your clients have available to them. And I should have, I tried to go as fast as I can to give Jason more time, and I apologize for only 6 short minutes there, but Jason is a very good resource. Now, the most important part of the presentation, take a look at your computer screens, everybody, my shameless plug, all right? Okay, again, we love doing these webinars, but we got to make money. So if you thought we did a good job today, please do give us a chance to work with your clients. We want your 1031 exchange business. The impression we gave you today is the same impression that we will give your clients. It's how we work, how we train our staff. If you didn't think we did a good job, well, you know, we might not be the exchange company for you, but we work hard to give very good impressions to your clients, and we respect your referrals. And we're also really looking for lifelong clients. You know, if you have a client who's really just one time and wants the cheapest person out there, they can get an online company for cheap. We know that our clients do exchanges for 20, 30 years. We build those relationships. We manage those relationships. We take them very seriously. And most importantly, if you refer us, we're going to make you look good. All right. So really appreciate the opportunity to work with you. We think nobody in the industry knows exchanges better than us. We are a free resource for you for any questions. Just give us a shot if you do have an exchange coming up. All of my information is on the board there. I'm going to go through and answer some of these questions that we might not have been able to address. So if, oh geez, there's a lot of them. I don't know if we'll get through all of them, but there are quite a few questions, and I think we got most of them. But if you do want to hang out and listen to me answer some of these questions, feel free to do so. Otherwise, have a great rest of your day. Okay, so Deirdre has a great situation where she lives in a property, but it's been rented for the last 3 years. So what happens, ladies and gentlemen, when you live in a property and then you rent it out, you lose your homeowner's exemption if you've rented the property out for more than 3 years, right? Because the homeowner's exemption is good for 2 of the past 5 years, right? So if you have a primary residence, the only way you get that homeowner's exemption is if you lived in it for 2 of the past 5 years. If you move out of the property and rent it out for more than 3 years, you lose the homeowner's exemption, and your only tax break that's available to you is the 1031 exchange. So Deirdre, I don't know if you've rented it out for more than 3, but it sounds like that might be the situation you're in. Lauren says, can the Medicare tax be deferred? Absolutely. So all of those taxes that you saw me go over are completely deferred if you do a 1031 exchange. Now, is Congress working on an update to 1031 exchange or Section 10 or Section 121 at this time? There's rumors all the time, rumors that 1031 is going to go away, rumors that they're going to increase the 121 limits. As of the date of this recording, no, we don't have any firm guidance on that. So it is kind of same old for right now. Okay, very good question from Angela. Does the replacement property have to have the same title as the one that was sold? For example, mom is on title to the property she's selling. Does mom have to take title to the property she's buying? The answer is complicated. The taxpayer has to be the same. Now, normally, when you sell a property, it's owned in your name, and you buy a property in your name. Sometimes a property is not owned in your name, it's owned in a trust. And if the trust sells, then the trust will generally buy. As long as there is continuity of the taxpayer, we're going to be okay. Now, to complicate things, sometimes you can have a person sell, and the person that wants to buy the property wants to put the property in an LLC. That is okay as long as the LLC does not file its own tax return. Because remember, what is most important in an exchange is continuity of the taxpayer. The same taxpayer that sells needs to be the same taxpayer that buys. And if the mom sells and she buys under an LLC that is disregarded for tax purposes, that is okay. Now, if you have questions about that on your exchange, you know who to call, okay? Someone else asked about a DST. I think Jason went over the DST pretty good. So most of these questions, guys, we went over, and we're running kind of late. I do have to jump on another call as well. So if you want specific answers to anything that we didn't cover, please do email me, and I'm going to go through this list as well and email you individually answers for anything that we did not specifically cover. So thank you all very, very much today. I hope you found the information useful, and sorry to go over our time. Just a lot of good information, a lot of good questions. But thank you all, and have a great rest of your day.